people that do know the things you don't know, guess what? They will use it against you. So you need to, it's your responsibility to be educated. It's your responsibility to be informed. Stop waiting for somebody to come and save you. The government ain't going to save you. If they were, they would have been saved you a long time ago with the right education. You're not going to get it because the system is designed to sustain itself. The system isn't designed for you to win. In order for you to win, you have to learn the game. And that's something you have to learn on your own, or you get a coach that has been down the road that you want to go, and now you learn it. You go to conferences, you invest in yourself, you submit to a teacher, you learn, you put into practice. That's what I got for them, bro. The Credit Summit is the only place they got to be. That's it.
What's going on? Welcome to the Credit Plug channel. Y'all see who we have here, so we're running it back, whenever Darain and I get together, we just drop bangers for real. So Darain, welcome back to the channel, man. I can't believe it's been about a year since the first Credit Summit. So I know we have a lot of updates to share about this upcoming Credit Summit, which I'll be in attendance. So if anyone is interested in attending, maybe you can't check it out live. We'll definitely have, video content and a lot of ways that you could participate. Link down in the description of the video for anyone who wants to, be a part of that. But
I mean, I'm gonna interrupt you right here, bro. They have to come. It's been almost 5 years of you giving solid information. You've helped thousands and thousands of people. Most of them have never even seen you in person. I think this is the perfect opportunity for them to come out and meet you, and not only that, come out and get information that's going to really set us apart from everybody else. Because, dude, like, most people don't know that in the last 12 months, 43 million people got hit with late payments. And most of the late payments that most of them got hit with are illegal. Wells Fargo late payments were illegal, TD Bank, and Bank of America. And those are the three most popular banks that most people have. And we'll get into those. So I think for anybody, with the amount of value we've been given over the years, I think it's only fair that they bring their family. And yes, guys, it is family friendly too. Bring your family, come learn this information. Hosea 4:6 is true, bro. My people are destroyed because of a lack of information. We've been taken advantage of by subprime lenders through interest rate, by banks through interest rate. And there's so much information that people don't know that can really put money back in their pockets. So I believe this is a conference for everyone, and everybody on your channel, bro, they need to pull up. I'm just saying, they need to pull up.
Absolutely. And it's interesting. What I'm going to be speaking about, I don't think I've really shared, I guess, on YouTube or any type of public forum. I've talked about it more so in private groups, but we're going to be talking some high level, credit. We're going to be talking about ways of being able to monetize and take advantage of having good credit, right? Because there's a lot of ways where you actually generate income from credit. And this is not the traditional, Airbnb, Turo. That's not what I'm talking about. We're going to be taking a deep dive. I'm not going to give too much away right now, but, this is definitely going to be high level, right?
Really?
Now, I wanted to talk about some of the changes that we've seen, right, in the credit space. Even going as far back as, pre-pandemic to now, right? And we've seen a lot of headwinds in the news recently, right? I did a whole analysis on Navy Federal Credit Union, right? Navy Federal Credit Union, if you look at their call report, so every quarter, NCUA, which is a governing body for a lot of these credit unions, they publish what's called these call reports, which just gives updates about the financial health of these credit unions. And from that analysis, so beginning in 2024, Navy Federal has been charging off on average about $300 million in bad loans, right? Every single month, 300 million. And that doesn't even include all the, late or derogatory accounts that are less than 360 days delinquent, right?
Mhm.
So we saw last week, I believe, Ally Financial, their stock price plummeted because they're starting to see a lot of these repossessions. As some of you might be watching this, Ally Financial is that no PG auto funding play, right? A lot of people are able to build up business credit, go to Ally and get these no PG autos. So what they're seeing is that the economy is changing, right? The ability for consumers to service debt is changing. I mean, I've seen it a lot too, where a lot of people, and this may not even be people who have really bad credit, but just, people who are carrying higher balances because maybe their income is slowed down, right? Or maybe.
Hold on a minute, credit plug. Hold on a minute. Remember, back in 2020, the average car payment was around 300 to 400. Right now, the average car payment is between 5 and 800. So it almost doubled. Interest rate doubled. So the effects of the economy, the marketplace is requiring more money, but nobody got a raise in salary. So if they were living off of 50,000, well, we're talking about an $800 car. Dude, that's rent. An $800 car note is rent. So if I'm going to pick between driving a car and living somewhere, come get that car and repo it. So just to your point, the market has changed tremendously, and the income hasn't gone up. Most people are still at a job. They haven't supplemented their income. There's no more PPP money, and we got to remember that. That influx of PPP money is gone out.
Dried up. It's gone.
Well, I won't say it's gone. Somebody has it. They're just not releasing it. It's somewhere. Because it doesn't disappear. It's just people don't have it no more. Right? And those that gave it out, more than likely, they're the ones that got it back because people went on shopping sprees. Right? So now all of that influx is gone. Now we're back to your regular job. The feds raised the interest rate. The car payments doubled. Now people are in a bind. Do I keep the apartment or do I keep the car? You got to sleep somewhere.
Exactly. So it's very interesting because at least for our generation, right? Like, I think for the past, I would say most of our adulthood, we've been in this low interest rate environment, right? Where rates are really low, borrowing costs are really low. So it's interesting, at least from my perspective, to see this change in the cycle, right? I can even, and this is something I've been talking about even a year ago, right? Because I see a lot of back end data, right? I work with a lot of banks. I can see loan approval rates, conversion rates, and so what I've noticed is that the number of applications is either steady or increasing, but the number of approvals are down. And this actually plays out in the data because there was a report that was released. I think Credit Union Times, which is like a publication, a newsletter where they share updates about what's going on in the credit union space, and they've seen loan originations go down, like personal loan originations, credit card originations, right? It's even happening at major institutions like Navy Federal or like First Tech, where they're not approving as many loans, right? And one of the...
All right, so I'm going to put a comma here again. Remember now, Navy Federal just got hit with discrimination charges because they were discriminated against Black and brown people with their applications. So the data is showing that there's a decline in approvals, right? But people are still qualified. So I call it redlining. People call it other things, where people that are equally qualified, but because maybe of a skin color or you live some certain areas, you got denied. The algorithms that the banks are using, remember this, guys, people natural people, are being removed from doing certain things that they can task and run an AI or an algorithm to do. So depending on how the algorithm is programmed, let's say that it was not manual underwriting, right? It's auto underwriting. And if some of these KPIs is off, let's say they set the perimeters, and the perimeters state that, within the coding, that people from a certain location, or people with a, like, whatever is inside of the codes or whatever they were doing, it caused a significant denial amongst Black, brown, and Spanish people. And it was enough to catch the CFPB's attention, where they got actually sued for this. So my question now to that is, okay, we're seeing the denials and the drop in the approvals, but how long was this going on for before it really came to light?
So I'll add to that, right? Basically, overall, right? Just looking overall, there's been a deterioration in the loan portfolios at a lot of these banks, right? Regardless of how you break it down, demographic wise, just overall, right? And then I actually was on a call. So one of the other places I get information is called the American Banker. So it's another newsletter. A lot of these companies will have these, webinars. So I was on a webinar. One of the companies is called Prism Data, PRISM Data. So they do cash flow based algorithms that look at, demand deposit accounts, so how much money you have in your bank account. I believe they're also incorporating like payroll information and stuff like that. So and then the other company that was there was Plaid, which you've probably heard of, where, they have APIs that can pull your banking data. And so the highlight of that webinar was the fact that they were saying over the next several years, over 80% of financial institutions are going to incorporate some form of cash flow based underwriting and gradually move away from credit score based underwriting only, right? Because again, credit score is backwards looking, whereas cash flow based is current and forward looking, right? They even have, so there's another company called TrueWork, TrueWork, TrueWork. There's another one called Pinwheel API. So like those companies aggregate payroll data from the largest payroll companies in the United States, not just payroll data, but time and attendance, right? So they'll know up until the day how many hours you worked in the current pay period. When's the last time you got paid? How much you've gotten paid, right? For anyone watching this right now, just go Google TrueWork. And the reason why I know these companies is because a lot of the banks and partners I work with are incorporating these new fintechs and even loan origination, softwares into their underwriting, right? You have another company called Numerated. You may have heard of, I forget the name of it, but there's another similar company where they're aggregating the data on behalf of these lenders, so they can make these quick lending decisions. But essentially what they're doing is they're taking a new approach. So the thing with the cash flow based underwriting, right, there's pros and cons. So let's say the consumer who has good, steady employment, right? They've been working at the job for a while, so they have a history of, steady income, but maybe they have a repo on their credit from 4 or 5 years ago where they can't go to Chase and get approved, or they can't go to one of these banks that doesn't have a business model that considers subprime credit, but they're otherwise credit worthy. So they were saying with this new cash flow based underwriting, that's going to open the door for those types of consumers, right? Where, they were kind of neglected because of their credit. But then on the opposite end, you might have people who have good credit. They pay their bills on time, but maybe they don't actually have verifiable income. So those people are going to have harder times relying exclusively just on their credit score or credit profile, right? So there's pros and cons to it. But based off of that meeting, they were saying incorporating cash flow based underwriting, which is just another set of data points, is going to open up more opportunities, right? For, again, people who have the steady income, but it's just the credit, because with credit, you're being judged on your past versus your present or even your future, right? So there's a lot, I think there's a lot of different ways to look at it. But overall, what I will say,
I gotta follow up on that too before you come off of this topic.
Yeah, absolutely. So the thing that I would say is that, we can't basically rely on these same methods of getting access to money that worked 4 or 5 years ago, right? A lot of people still talk about trade lines and AUs and all of this stuff, right? But that's not really what's driving the underwriting decisions, at least going forward. So we have to adjust and prepare ourselves to position ourselves to get access to the money, because when we have access to capital, that just opens up so many doors. And again, I can speak personally to a lot of examples where being able to access capital has overall just improved quality of life, opened up opportunities, and just enable you to pull the trigger on certain things. So going back to what you were going to follow up with.
So, all right. So basically a new type of consumer reporting agency is being birthed right now. Like we're in when someone's pregnant and they're in that, what is it called? The last trimester? Is that what it's called? So guys, we're in a unique period now where, because of technology and what has been working the last 25, 30 years since FICO has been developed, now we're talking about data and the amount of data it's going to require to do this. And the second thing is where they getting this information from. So now we're talking about consumer law violations, your right to privacy, which companies, your employers, when did you give any authorization now? Because y'all know I'm the consumer law expert. So how I see things now is, okay, they're going to use these new underwriting, these cash flow based underwriting, all of these great things. I'm with it. But my question is the information and where it's coming from and the permission that was given, right? So if employees of these corporations or that's employed by these employers, if their information down to their clock in, their time off, how long they've been at the company, there has to be some form of release from the consumer or the employee that gave their employer that written consent or permission that they can furnish their data to house in different companies. So when we're talking about how the information is maintained, how the information is distributed, and the accuracy of the information, one is going to make it easier for y'all to dispute things on your credit. That's number one. Because now the level of information that they have to go through to prove accuracy goes all the way back to the source. So it doesn't matter where they're going to allege the information came from. Well, we have to do a trace of the information, how our files being maintained, the accuracy and completeness of this information. And furthermore, was there even permissible purpose? Because any corporation can become a consumer reporting agency if it's in the business of compiling data and then furnishing that information. There's no special skills required, right? So now we're going into a different route, and this is what I talk about forbidden credit. Guys, like, I want you to look at me right now. It's important that you guys learn how to sue. Like, some of you might be saying, Daraine, what are you guys, I'm telling you, learning how to sue, whether arbitration or small claims, is a necessary skill every consumer needs to have. All right, let me give you an example. I've been having the worst internet service with Xfinity, right? Comcast. Dude, like, I don't even want to say it right now to jinx myself, but in the middle of streaming, I would lose internet, bro. And then I get a message that they're doing maintenance and all of these crazy things. We lost service. But every month they collect a full payment from me for a service that I'm not getting. So you know what I did? I sent them a pre-demand letter for $15,000. I'm taking them to court. So learning this type of skill puts me at the forefront of my own success. What does that mean? That simply means that I am not going to tolerate any BS from anybody. If I'm using my cell phone and my cell phone service starts acting weird, you know what? T-Mobile is going to get a pre-demand letter for a lawsuit. Experian, TransUnion, Equifax, right? Tomorrow, I go and file a default judgment on Equifax for $15,000 because they failed to respond to my statement of claim where they had my credit pulled and they had no permissible purpose, and they can't prove that these corporations that they gave had any permissible purpose. Why is that important? The law says written permission must be given. Your consumer report cannot be furnished to any person without a permissible purpose, and the purpose must be certified under Chester versus Purvis, which is the case law that set the precedent for that. And you know what's crazy? You know how they tell you the propaganda that small soft inquiries don't matter? I'm sure you've heard that soft inquiries.
Right, right.
Did y'all know that there's no differentiation in the law for for soft inquiries or hard inquiries? It only speaks about an inquiry. You see, we've been misled, guys, and this is where forbidden credit comes in. We've been misled to think that a soft pull means nothing. A soft pull is the same as a hard pull. The only place a soft and a hard pull matters is FICO. FICO is not your consumer report.
Right. And, you know, if you go on Experian, right, you look at your detailed credit report, it actually tells you every institution that did a soft pull of your credit and the date in which they do it. So, for example, if you log on to like even a lot of like credit monitoring services, you know, they're doing a soft pull of your credit. It's interesting because I was actually looking at that the other day, and I was like, wow, like a lot of these companies that I was unaware of, there was periodically they do a soft pull. Like they might do it monthly, they might do it every quarter. So yeah, I mean, you really have to look at the details to see exactly what's going on in terms of, you know.
I'm gonna put you on, bro. I'm gonna put you on. All right. So Equifax, right? Let me find these soft inquiries, and I'm gonna show you why I'm getting. So I used the $15,000 to test them out. So I'm going after Experian next. And Experian, I'm going after Experian for $66,000 because there's about 66 soft inquiries on my report. So, okay.
Wait.
Huh?
Can you explain to the people what is a pre-demand letter for those who don't know?
Okay.
Just break that down real quick.
All right. So I use pre-demand for different things. So, all right. When it comes to TransUnion, Equifax, and Experian, I'm not sending them a pre-demand. What I'm doing is I'm disputing directly, right? And I know they can produce the information, but that's not the point. The point is you must dispute, because the law says that if something is inaccurate or incomplete, you must dispute it. If they fail to provide the proof now, that's where I get them, because I know they don't have the proof. Right. So when we're talking about a pre-demand now, we're talking more in the realm of the arbitration side, where let's like Comcast, for example, right? I'm getting shitty internet service, right? It's interrupting my calls. I can't do consultations. I can't do Zooms. It's affecting my business and my credibility. So small claims amount in Georgia is 15,000, right? I'm going after them for 15,000. So with Equifax, TransUnion, and Experian now, so they have a whole bunch of where's my Experian report? I can't seem to find it. But anyway, so this is an example, right? So all of these right here are soft inquiries, right? Any person that accesses your you know what? Let me read the law itself to give you guys some more perspective on how I'm coming up with these numbers, because some of you might be saying, Lorraine, how did you come up with 66,000? I'm explaining it to you guys right now. So I want you guys to follow with me right now. Y'all are getting this lesson live. 15 USC 1681N. And we're going to go to civil liability for willful non-compliance, right? So when we go here, we're going to read what it says. A, any person. Well, I want you guys to click on the word person.
Do you want to share your screen? Or are you just going to read?
Are you able to pull it up? Let's
Yeah.
go to 1681N, bro. Let's go to 1681N.
Shoot
Civil
me the
liability
link.
code.
Put the link in the stream, and I'll pull it up on my computer.
Got you. I'm gonna drop it right now. Y'all are getting a piece of what my mentorship is like. So this is great for y'all right now. I'm telling y'all, like we've been okay with deletions, and deletions are cute, bro. No, you owe me money, and I'm coming for it. And these are the things that I'll be teaching at the Credit Summit, and that Credit Plug is gonna be showing you guys. Like it's the place you need to be. So let me know when you pull it up, broski. And I'm going to dive into
let me see where I'm trying to. Oh, okay. Here you go. My bad. All right.
Oh, I may have put it in a private.
No. I got it. I got it. Yep. I got it right here. So. All right. Here we go.
All right. I want you to scroll down to A. All right. So I'm going to read A now. Any person who willfully fails to comply with any requirement imposed under this subchapter with respect to any consumer is liable to that consumer. We read that part, right? All right. Do me a favor now. I want you to open up another tab. And I want you to go to 15 USC 1681 B2, or just B. Just put B. 1681 B. So that we're going to go to permissible purpose. All right, I want you to scroll down a little bit. All right, let's read it. Subject to subsection C, any consumer reporting agency may furnish a consumer report under the following circumstances and no other. Meaning that the conditions listed here is the only conditions where a consumer report can be furnished. Look at number 2. In accordance with written instructions from the consumer to whom it relates, right?
Okay.
All right, written instructions. So in order for any company to get it, they must have what? Written permission. That's why they say, hey, sign this document so we can pull your credit. For those of you that are wondering what that means, when you go to get a car or you're applying for a credit card, you have to do an electronic signature, electronic sign first before your credit gets pulled. That's that permissible purpose document that they need to supply to a consumer reporting agency to have your credit report pulled.
Okay, let me ask you this, right? So it says written instructions. What about verbal instructions?
Verbal is not. Nope. Verbal
okay, so if you're the reason why I'm asking, because there's been times where, for example, let's say you're on the phone with a lender, for example. This could be like a BHG or something like that, and they'll ask you like, do you grant permission to pull your credit? So are you saying that when they do that, that's not valid?
It's not, because the law says
interesting
written instructions.
Okay.
The law says written instructions. Now they may have a feature where they have a voice audio transcript where your yes could be
they record the conversation,
a recorded conversation, and then they will send you the terms and agreement later on and include that in there when you sign. But written permission must be given. Without the written permission, it is identity theft. Right? So now that we know that written permission is needed, so let's go back now to the other tab, 1681N. So any person, so scroll down to B. In the case of liability of a natural person for obtaining a consumer report under false pretenses or what, knowingly without a permissible purpose, actual damages sustained. Now, if there are multiple hard inquiries on your credit, and you did not give any of these lenders any written permission, you can get actual damages. So let's say, Credit Plug, that you're building your home right now, right? And you decided that you needed a $300,000 line of credit, but for some reason, 5 banks just hit your your credit report, and your scores tanked as a result. Now, it's not the tanking of your credit that's the issue. It's the fact that they had no permissible purpose, and a drop in credit score that caused your denial came now as a result of their failure, which constitutes actual damages because you lost that opportunity. You can go for that 300,000, right?
Right. That's a really good point that a lot of people don't think about, right? Because there's an opportunity cost, right? Where, for example, in that case, this happens a lot with auto vehicle financing, right?
Mhm.
We talk about this. You go into a dealership, they try to get you to go through their preferred lenders. They're going to pull your credit 10 times. That lowers your score. So there's an opportunity cost because now you have a lower credit score. So if you were to go somewhere else, you're going to get denied. So you getting denied, you're not going to have access to whatever funding to maybe even take advantage of whatever opportunity it was, right? In the case you said, let's say I wanted to get this 300K so I can go purchase a business, right? Well, now I can't purchase the business because I can't get approved because they pulled my credit 10 times without my permission. Therefore, I can't take advantage of that opportunity. And, that business deal would have netted me, $1 million, right?
Actual damages. So now we're going to put that 300,000 plus the $1 million opportunity loss. So now we're at 1.3 in our lawsuit. That's how it works, right? But you must be able to prove damages. So the denial letter that you're going to get is a key component, right? But the other part of it that I'll just put it up back real quick. There's one more part that I wanted to show them, how you can get $1,000 for inquiry. You see where it says actual damages sustained by the consumer as a result of the failure, so let's say that I wasn't damaged, right? Let's say I wasn't damaged. Let's say I didn't have any opportunity lost. No, at the bottom, we're at B.
Okay. Right.
So R $1,000, whichever is greater. See that part?
Mm-hmm.
For every inquiry that is not tied to written consent or a permissible purpose is $1,000. I'm going after Credit Karma for $66,000. I'm going after Equifax, Experian for $66,000. Right? TransUnion is probably $120,000 because they have been telling us that these soft pulls don't matter. The law, a pull is a pull. The law doesn't care if it's a soft pull or a hard pull. A pull is a pull, and it requires written permission from the consumer. So learning this skill, ladies, and like you can print, like this is just, let me show you.
No. Let me ask you this, Durain. So, because
let me tell you something. What does this say? Can you see it?
I can't see it. No.
So this is a statement of claim, right? Oh, do the thing. Put the camera back, and then let me.
Okay, there we go. Yep, I see statement of claim. Yep.
You see the Rain of
Yep.
I'm not playing no games. I'm not. And you see this type of confidence and this type of skill that we need to learn. Dude, do you know what maybe $100,000 lawsuit could do for a family right now that has been violated for years, having their information inaccurate, being lost opportunities? Like, do you know what $100,000 can do for a lot of people? And we're not talking about business funding here. We're not talking about monies that you got to pay back. We're talking about violations on your consumer report. You won this lawsuit. Now you got this 100,000. You can do a lot with your family with that.
Now, let me ask you this, just to go back, right? Mm-hmm. Now, when you sign up for a lot of these credit monitoring or, utilizing different websites and stuff like that, because a lot of times when people sign up, you're not reading the fine print, right? So could there be instances where there's sort of a implied consent based on you even utilizing like a Credit Karma, right? So if you in the terms and conditions, right, they might vary certain things. So it might, even though it at each particular instance, because again, Credit Karma or even Experian, Credit Sesame, they all have these APIs that soft pull your credit from time to time. I mean, there's even, for example, there's banks that I don't even have a relationship with that I see on Experian, like the detailed Experian report, where they're soft pulling the credit. And actually, I'm gonna pull it up just so people could actually understand. But go.
While you're pulling it up,
yeah.
So let me. All right. So Equifax and TransUnion, Credit Karma may have some point there, right? But I'm still going after them. Mm-hmm. But what do we know about Credit Karma? Credit Karma does not supply Experian information. So what is Credit Karma doing on my Experian report 66 times?
Mm.
What's the justification for that one? You furnish Equifax, you could plead that case. You furnish TransUnion, you could plead that case. But y'all don't furnish Experian. Why are you on my Experian? And where did I give you permission to pull or soft pull my Experian report? I did not. Never did.
Right.
So now if we're talking about Credit Karma having 100 pulls on soft pulls on my TransUnion, well, now we're talking about justification. At what point is there a justification for 100 pulls? See, they are doing something that they don't want people to know, and they've marketed under soft pull doesn't affect your credit. Why? Because they are shopping you around. Have you ever just gotten some pre-approval in the mail? And you're wondering where these approvals. This is how they do it, and they're making money from your information. Well, I'm gonna tell you, I'm coming after all of y'all for every inquiry on my credit. Ain't nobody is safe no more. They're not. Like nobody is safe. They're not safe anymore. None of them. No consumer reporting agency, no debt collector. Nobody is safe from me anymore, bro.
So let me ask you this. So with this information, right, if everyone all of a sudden starts suing them, like, do you think that would stop all of this from happening? Or are they relying on the fact that, maybe people don't, people aren't going to be educated enough to, even know that they're being violated?
Mm-hmm. You said it. You said it. Ignorance is the biggest business in America. So ignorance is paired with bad credit, because when you don't know how to fix your credit, they win. All right, let's look at it now. When a loan is being generated, or lines of credit, a finance charge is normally associated with the origination of these credits or loans or credit cards, right? When we go to Truth in Lending, 15 USC 1605, and it speaks about the finance charge, it also speaks about a type of insurance that is inside of the finance charge that protects the lender against any credit loss, or in the event that the obligor defaults on the payments. So there's a insurance policy in there. Now, right. So whether you pay it or don't, and I'm not telling y'all don't pay y'all obligations, that's not what I'm saying. They're still getting paid. Then it gets charged off the profit and loss. Then they can still attempt to collect or resell it to a debt collector. So remember now, all the payments that you made, they have all those payments. If a down payment was involved, which is fraudulent, if there's a finance charge, they still have that down payment. So they got paid around 5 to 6 times, right? And the consumer is left with the L, because they know that the consumer, or America in particular, they're not educated on how the banking system works or how credit works. We are not informed about the use of credit and how to properly utilize credit. So with this information, they know that, okay, 99% of people in the US don't even know what is called usury law. I'm betting right now that y'all that are hearing my voice don't even know what usury law is. So I'm going to give you this challenge.
Break it down, because that's important. And another thing I wanted to also talk about in regards to that, because there are some lenders, you got to look in the fine print, right? Are you familiar with tribal lending?
No.
Tribal lenders. Mm-mm. So basically, there's they fall outside of a lot of those state usury laws, right? Where it's like, okay, a limit on the amount of interest that they could charge. And it varies by state, right? So each state is a little bit different. Mm-hmm. And you made the point too in a previous live we did about when it comes to military personnel, right? Like it's also limited. But what I've also found was that a lot of these sort of fintech types of companies when you read the fine print, a lot of them are backed by these tribal lenders. So for those who don't know what tribal lenders are, they basically it's like the Indian reservations, throughout the United States. They have a different set of laws, right? They don't necessarily have to abide by some of those usury laws, right? So in some cases, like it's ridiculous. Like they might be charging 800% APR on a cash advance, right? So you really have to read the fine print. But anyways, for those who don't know, like what are the usury laws?
So the usury laws are laws put in place by certain states. Every state has their own version, right? Like let me give you an example. New York usury law is about 16%. Anything over that is criminal. Florida, I believe, is 18%. Anything over that is criminal. So there are different states that have different usury laws. So all you got to do is type in, what is my state usury law? So if you're in Georgia state usury law. If you're in Florida state usury law, right? You're in Maryland, right?
Mm-hmm.
What's Google Maryland state usury law? Now I'm curious because I want to know what's Maryland state usury
law. All right, let me pull that up.
Now I'm really curious. I like when I get curious too,
I think it's like 30-something%.
What? That is, dude. That is nuts.
Let me see. Maximum. Oh, I can't see.
The legal maximum in Maryland is 6%.
6%. That don't make sense though.
8% under a written contract. So between 6 and 8, y'all got it good over there.
That can't be right though.
It's here. It's right here.
Okay, that's crazy because
right here, 6%.
6%. So what does that mean?
All right. So that simply means that the maximum interest rate y'all should be paying in Maryland is 8%, right? So if you guys are paying anything over that, it's criminal. You are paying excess of your state usury. So what you can do is, there's a letter on my website. It's called the interest rate swindle letter, right? So I built a letter that you can use, and you send it into the institution. You can either get one of two reliefs. They can either take all the excess, put it in a check and send it to you, or if you have a balance on like the account, they can credit it to the account. I've done it before. That's why I know the thing works. I've done it with the military SCRA, and I got about like a $2,000 check, and this was younger me. I just went and blew. I went and spent the $2,000, bro. And you know what's crazy? There was probably more than $2,000 that I paid in excess, but because I was young and dumb and I saw a $2,000 check, I just went and spent it. But imagine a family that's strapped for cash and they've been paying in excess of their state usury law for years. A $5,000 or $10,000 check could do a lot for somebody.
Right.
That could be the difference between the mortgage or the rent being paid for the next 2 or 3 months. Groceries in the house.
Yeah, I mean, and the crazy part about it, people don't realize too, with anything, whether that's a mortgage, whether that's an auto loan, personal loan, you got to look at the amortization schedule to actually see how much of your payment is being applied to principal and interest. And this is something I think we discussed this previously as well that I didn't know. So like when I got my first car loan, the payment was about $450. It was a 2010 Nissan Altima, right? And I'm paying this. I think it was about 15,000 plus the gap insurance. It was like final like 17,000. So I'm paying that $450 for like 3 years straight, right? And so I'm factored in because I know if I'm paying $450 a month, so each year that's about $5,400. So then if 3 years, that's like 16,200, right? So 3 years later, I call in because this was through Credit Acceptance, which was a subprime lender. I call in And they have the automated voice that tells you, what your balance is, what your current balance is, what your payoff is. And they're like, mind you, the original balance was about like 17,000. And, I call them 3 years later and they're like, yeah, you still owe like 11,800. I'm like, what do you mean?
Crazy.
Like, I'm shocked. I'm thinking it's almost paid off. Little do I know, they send me the amortization schedule, and I'm looking at it and I'm seeing that like out of this $400 payment, like 400 of it is being applied to interest in $50 or $60 or something is getting applied to principal. Over time the more gets applied to principal than interest. So at that, around the time when I checked, I think it was probably a little bit more that was going to principal than interest, but I had no idea. I thought if I paid $450, then the balance goes down by $450. But that's not how it. That's not how interest works.
Crazy, bro. You know what's crazy? You probably were paying an excess in interest rate than your state allowed.
Probably, and I'm pretty sure I paid double than what the original car was.
And guess what? Again, too, that gap insurance that you were paying for, that should have been included in your finance charge, because all charges, interest rates, and premiums are included in the finance charge. So you shouldn't have been paying for gap.
Right, but see, how they get you. I mean, again, I was young at the time, but they're basically like when you finance. Let's say if you total the car, and the car's worth less than what you financed it for, that's basically to cover you. But
I get that part. Yeah, but it goes back to the things that we don't know, because remember now, in your finance charge, it says insurance premiums are included in the finance charge, which means your entire gap was already paid in your finance charge. Your gap was in there.
Yeah.
So because you didn't know, and because I didn't know when it happened to me, because remember, I had me a 2007 Nissan Altima as well with 75,000 miles on it. It's crazy how we can go back now and laugh at this stuff.
Yeah.
But imagine the amount of people right now that are us 5, 6, 10 years ago that's going through this with a used car because it's their first car or only what they can afford, and their payments are data for rent. And they don't know this. And this is why I'm telling you guys, it's important that you guys make your way to the Credit Summit. This is not information you're going to learn in school. That's number one. This information, yes, we give you all information online, yes, but there's more to the information and the practical application in your life than what you are hearing now. You got to be in these rooms. Credit Plug didn't become Credit Plug by being cheap on his education and saying, you know what, I'm not going to invest in myself. He wouldn't be in a room with bankers, lenders, and underwriters giving him the game of how the back-end system works. Do y'all think I would be this good at consumer law if I didn't pay almost $400,000 to learn from different coaches? I taught myself law, literally.
Exactly. That's another good point too. Like once you have the information, it just like for example, like if I walk onto a dealer lot today, it's a different dynamic, right? Because for one, I'm informed. For two, it's not like you change the power dynamic, right? When a lot of people go to the dealership, it's like, let's say if you have, less than perfect credit, maybe your income's not there, maybe you don't have the documentation or the paperwork or whatever, you're kind of going, your approach is kind of
inferior.
Yeah, inferior, right? Versus now, if I go into a lot on any dealership, I know that they can't run game on me because, for one, I can pay for any.
Talk that shit, bro.
I can pay for any car cash if I want it, or I could finance any car that I wanted without their banks, right? I could write a check, I could finance whatever without relying on them to tell me, okay, we're going to put this on it. You got to get this service package, this fee, that fee, that fee. I'm like, no, give me the out the door price.
Because you're informed.
Informed,
now,
right?
You now think of Credit Plug now. right? And think of the you before you became Credit Plug, because Credit Plug is informed, Credit Plug is educated, but the 2010 Nissan Altima dude wasn't.
Absolutely not.
So think about the two. It's still you. It's still the same person, but completely different authority. So how for somebody now that's the you 10 years ago, right? What can you say now to that person and the importance of not only being in the room, but being educated to where your Credit Plug now versus when you were just Alan, just going around, not thinking about nothing?
So I'll tell you this. Being in the rooms will greatly reduce your learning curve, right? And even to this day, you know, I'm still investing. I'm still getting into rooms so that I can get a higher perspective on certain levels of credit. I mean, I've had this conversation with you and a couple other people, how there's an even higher level when it comes to this space, right? You know, like, for example, right, a lot of people do funding now, right? You know, help people get funding. But there's an even higher level to that, because I'll be breaking this down at the Credit Summit, you know, just giving you guys like behind the scenes of how a lot of this, you know, finance kind of works, right? So and the reason why I was able to kind of get a lot of this information is through, I would say, the past 5 years of interacting with bankers, lenders, fintech companies, helping blow up their valuations. And one thing that dawned on me was like, okay, because a lot of these fintech companies will come to me and it's like, hey, look, you know, we're trying to increase our valuation so that we can go back to investors and raise money. So we need to, you know, increase our ARR, which is the annual recurring revenue. We need to increase our user base. So they come to people like me to kind of help them. So, you know, long story short, you know, I didn't really understand, okay, what is their game plan, right? And so it finally dawned on me when I start to see a lot of these companies either get acquired or have these 8-9 figure exits. And I sat back, I was thinking like, okay, they built a product. Maybe it was a credit card, maybe it was a loan product. They expanded the market base, and then they got acquired, they sold, they exited, right? But then I was thinking like, I contributed a lot to that upside, but they got paid on the back end. I was getting paid on the front end, right? So I was like, what are they doing? What are they doing? What's their business model? So I'll just lay this out real succinctly, you know, for people to understand. A lot of these companies, how they get their money to lend, it's through.
You sure you want to go down this rabbit hole, bro? Because
I'm not going to go down the rabbit hole, but I just, so in a lot of banks, you have what's called capital markets, right? So the way I like to lay this structure out, right? You have the bank, right? The bank, this could be a FinWise bank, a Cross River Bank, a Sutton Bank, Academy Bank. You know, a lot of these like fintech as a service, they offer fintech as a service, banking as a service, warehouse lines of credit, balance sheet lending, right? So the banks are in the business of lending out money, right? So the banks, a lot of the smaller banks, regional banks, aren't as good as finding qualified borrowers for the money, right? So what they basically do is task loan originators, fintech companies. So a lot of these fintech companies will get what's called a warehouse credit facility. So a warehouse credit facility is basically a line of credit. It's like a semi-secured line of credit. And this is the mind blow, right? These fintech companies will basically get a warehouse line. Let's say it's a $10 million warehouse line, right? And it usually scales up after they originate some loans, and then you know, they track their performance. It's called a loan tape. It's kind of like a resume of their loan portfolio, how those loans have performed. So they'll go back to their warehouse lender after, let's say, a year, 18 months. Hey, look, this is the performance. the warehouse lender be like, all right, look, we'll increase you from 10 million to 50 million, right? Web Bank is one of the biggest players in the space. Web Bank, Cross River Bank, like most of the fintech, it's a small space. They have a lot of these sponsored banks on the back end who are funding them. I'll give you guys a quick example. A lot of you guys know about Capital on Tap, right? Business credit card. I think I have an example somewhere around here, but behind them is Web Bank, right? So Web Bank is behind Capital on Tap. As a matter of fact, hold on one second. There's another credit card. This is the Gemini credit card, right? Some of you might be familiar with them. If you look on the back, issued by Web Bank under licensed by MasterCard International. So right, Web Bank, they're also behind a lot of these credit cards. So basically, again, with these fintech companies, so the fintech companies don't have the bulk of the money that they're originating with, right? They have to get these sponsor banks. The sponsor banks will give them a warehouse credit facility. I mean, some of these warehouse credit facilities can be 500 million, $1 billion, right? It all scales, right? So
crazy.
The way they get these lines of credit, or so the warehouse, it's kind of like a semi-secured line of credit, right? So the whole goal of that line of credit is so that they can repackage it and distribute it to customers, right? So what these fintech companies will do is once they secure the line of credit, and the way they secure it, they have to usually have to put a little bit of their own money into what's called a loan loss reserve. So this is a reserve account. It's in a first loss position. So if any of their loans default, that reserve account gets hit first. So it basically absorbs the loss first before the warehouse lender absorbs any losses, right? So that's required. But here's the kicker. These companies can leverage their money by a factor of 20. So let's say easy example. Let's say you want to one of these companies wants to secure $10 million, right? They would basically have to put 5% of their own funds into a loan loss reserve. So on 10 million, that's $500,000 of their own money that they'd have to just put in a reserve fund, loan loss reserve in case of defaults, right? And then on top of that, they need a track record. A lot of them are also venture backed. So it may not even be their own money that they're putting in that reserve. A lot of them will issue what's called a private placement memorandum. And that's how they're able to raise money from private investors to invest in a lot of these pre-IPO types of fintech companies. So anyways, they're making the way these fintechs make money, they're going to make money off an interchange fee. So every time you swipe a card, whether that's a credit card, a charge card, there's what's called swipe fees. So this is what's split between the bank and the Visa or MasterCard, right? So Visa, MasterCard, Amex, whatever the payment network is. So if you're a business owner, for example, someone comes into your business, they spend $100 on a credit card, that business is not getting the full 100. So if anyone's ever had a merchant account, they use PayPal, Stripe, it's like you pay 2.9% plus 30 cents or 10 cents or whatever it is, right? About 3%, let's just say. If you go to use Plastique, they're going to charge you 3% or Melio or whatever. So that's basically the fees that the merchants have to absorb, but that money goes back to the credit card issuer, right? So that's how a lot of these banks make, or fintech companies, loan originators make money. They also make money, and I'm sorry for going off topic, but
no, it's good. But my thing is this, bro. You will not find this education in any textbook. You're not going to find this education in college. You're not like. This is the reason why people really have to be in the room. Like you literally just described how banks work. And I think that's what we're going to call your session at the Credit Summit.
Right.
How banks work.
So here's the other thing, right? So let's say a company, right? For example, I'll give you guys another example. A lot of you guys know about BHG, right? Bankers Healthcare Group. Very similar model, right? They'll either raise money from accredited investors, they'll also have these warehouse credit facilities, right? So the warehouse credit facilities allow them to originate loans. And then once they originate loans, so they'll usually charge origination fees, and they have a back end interest rate spread. So let's say, for example, you get a business loan through BHG. I'm just throwing out an easy example, $100,000, right? You may not get the full 100 because they're going to charge you a origination fee, let's say 5%. So you'll get, the proceeds will be 95,000. That's how much a borrower will receive. They still have to pay back the 100K plus whatever interest. Let's say the interest is, 12%. So a lot of these warehouse credit facilities, the way they will price it is based off of the SOFR, SOFR. So you guys could check that out. It stands for the Secured Overnight Financing Rate. Right. So SOFR plus a margin, in the same way that, let's say, if you got to have a business line of credit, it might be priced at the prime rate plus a margin. Right. So the prime rate prior to yesterday's interest rate decrease was about 8.5%. So the Federal Reserve decreased interest rates by 0.5 percentage point. So I believe the prime rate now should be around 8%. And just let me cook for a second, because I just want to illustrate a point, right? So so there's a site called Trading Economics, right? So this has a lot of information on interest rates, things like that. So I just want to pull this up real quick. So let's just say the prime rate. All right. Okay, so you guys can see this, right? So you see that the prime rate, 8.5%. Mm-hmm. They'll update it for September. So so the prime rate works in lockstep with the Fed funds rate, right? So let's just look at the interest rates real quick. Fed funds rate. So the prime rate is usually the Fed funds rate plus 3, right? And they work in lockstep. So you see how the Fed funds rate's 5.5 and the prime rate is 8.5, right? And then what I was talking about in terms of the SOFR, which is how a lot of these capital markets programs will sort of price it. I think the SOFR is like 5.3. Yeah, about 5.3. You guys see that? Mm-hmm. All right. So pretty much, when looking at these different rates, right? Let me zoom in a little bit more, right? So just one thing to kind of realize, right? The Fed interest rate. So whenever they're talking about the Fed is lowering rates, right? This is what they're talking about. But the bank lending rate, or the prime rate, is how banks price products, usually consumer products. So they can either use the prime rate, or sometimes they'll use the SOFR, Secured Overnight Financing Rate. This is more common in capital markets, the SOFR, right? So going back to the example that I was sharing with you guys, let's say, someone, a fintech company gets a warehouse line of credit. It might be the SOFR plus a margin. So like 5.3 plus 2. So an example, and I'm just throwing this out. I don't know exactly.
Plus 2, is that what the fintech is charging for them?
That's the fintech's cost of capital from their warehouse lender. Right. So let's say
the warehouse is paying 5 to the Fed.
Right.
And then the fintech now has to pay that warehouse. So that 5 plus 2.
Plus
and
a
then
margin.
When they relend to the consumer, that's where that 10 and that 12% comes in, because they got to put theirs on it.
Exactly.
They have to cover for the Fed. They have to cover for the warehouse and their margin too.
Exactly. So it's there's a couple of terms. So there's a spread between their cost of capital, which and again, the SOFR is 5.38 as of right now. So let's say a company like BHG, their cost of capital might be 7.38. Or let's just say 7.5 to keep it clean. Mm-hmm. If they're charging 12% on a loan, they have a let's say 4.5% margin. I'm in the wrong business, bro. But let's just say they have a 50 mil, or I'll put it this way, a $100 million warehouse credit facility, right? Mm-hmm. So what's 4.5% of 100 million, right?
I gotta look it up.
That's $4.5 million,
Jesus.
right? But here's the kicker too. I was telling you how the warehouse credit facility, it's a revolving line of credit.
Mm-hmm.
So what happens after they originate loans? Let's say they originate $100 million worth of loans. They're going to earn $4.5 million on the back end, right? But then what happens is they sell the loans. So they get those loans off of the balance sheet, off of the warehouse line. So they'll sell those loans to another bank. So that there's something called a forward flow arrangement where an originator will sell a loan to a bigger bank, just in the same way with mortgage lending, right?
Are we talking now about securities where they're packaging these loan products?
I'll get to that.
Okay.
Yeah, I'll get to that. So there's also the securitization side, where they pool loans together into marketable securities, right? But just in terms of I'm just trying to illustrate, there's a front end operation with loan originations. Mm-hmm. And then to free up that line, so once they use the warehouse line up to the limit, they can't lend anymore. So in order to continue to lend, either they have to get an increase from their warehouse lender, or they have to sell the loans. So what a lot of these companies will do, they create their own secondary market to sell those loans, right? And this is where we're getting into, and I'll talk about this at the credit summit, but usually it's bank to bank. So there's a couple marketplaces. There's what's called Loan Street, right? So
are we talking about investment banks or regular banks?
So the buyer. So usually it's bank to bank, right? So
it doesn't have to be an investment bank.
No, not necessarily. Okay. It could be credit unions. It could be third party lenders as well, right? But basically, there's marketplaces where banks will buy and sell loans from each other for a variety of reasons. Usually for balance in their portfolio, or sometimes banks have excess capital and they have a hard time actually originating loans, so they might buy loans from another bank, right? There's a couple of examples where, for example, like some of the biggest credit unions actually buy loans from other banks. Like PenFed will buy loans from like Prosper, right? You ever heard of Prosper? Another fintech lender. They originate loans, charge origination fees, and then they'll sell the loan to a bigger bank. Now, it's the same model like with mortgage originations, right? So you might have a local mortgage originator. They have a warehouse credit line, right? So they'll use that warehouse line to originate the loan. And then what they'll do is they'll sell that loan to a bigger bank or to a Fannie Mae, Freddie Mac, right? Or one of these aggregators who will buy the loans off of them. So then they're able to turn their line of credit over multiple times. So they're making money on the front end and on the back end. So it's a whole different, and then the crazy part about it, these originators, right? They're using a small portion of their own capital to leverage to secure a line of credit. So they're leveraging their money in some cases 20 times, because some of these warehouse facilities, they might only require a 5% loan loss reserve. Wow. Yeah. So they're able to leverage their money, and then
I think
they're making front end fee. Yeah, they're making front end fees, back end interest rate spreads.
Market. Oh my God.
Yeah. And the next part of that, here's another opportunity that a lot of people don't know about, and this is what I'm also going to talk about. So you can actually buy loans. Like, you don't have to be a bank to buy a loan. So, like, for example, let's say there's a franchise, I don't know, like a McDonald's, right? Someone opens up a McDonald's, they borrow money from a bank. You can actually buy that loan, right? Where as a it's called loan participation. So as a purchaser of that loan, you're going to receive the monthly principal and interest payments, right? So there's a new asset class, and it's not really new, but usually it's only open for other banks or accredited investors, right? So accredited investors are people who I think the requirement, you have to have like $200,000 annual income for the last 2 years, $300K if you're married, or if you're like a licensed financial professional, or even if you have a net worth of over $1 million, excluding your personal residence, right? So a lot of those opportunities where you're able to make, and again, I've actually done this, a 10, 13, 15, 20% returns, right? When you're getting these monthly interest payments. So that's a whole new, again, not a new asset class, but for the average everyday person, you're unable to
been kept
participate with that, right?
It's forbidden knowledge.
So you could profit from a bank without being the bank, right? And people don't know that. So there's a saying, someone's debt is another person's income or profit.
Asset.
Right.
Yep.
So and here's another thing too. A loan, when you buy a loan, right? A loan is an asset, right? Because it produces cash flow, right? A loan produces cash flow. So it's actually an asset that you could also then leverage. Like you can borrow against a loan. So for example, let's say, you have a loan, Durain, you take out $100,000 business loan. I can go and buy that loan, right? So then I could receive the interest you pay on that loan. And then I could collateralize that loan to then borrow against it, because again, it's an asset.
And if I default, you're in first lien position, so now you can foreclose on me. Whatever equipment I have, you can take it and sell. Oh my.
Yeah, and that's why UCCs exist, because it's kind of like a reassurance, and that's why certain lenders will require a UCC, right? Because they're selling those loans to investors. So there has to be some type of recourse in case of default to be able to, get that back. So
those funds, yeah.
So it's so crazy, just understanding how these banks get the money and just the opportunity. And so again, we're taking a deep dive at the Credit Summit. So definitely make sure y'all check that out.
I can't wait.
Absolutely. So again, anyone interested, there's a link in the description of the video. Any parting words before we wrap up?
Man, so I thought I knew a lot about how banks work. I know it from the fractional reserve lending side, but dude, you just took my education to a whole nother level. I'm talking about now how it really works, because now I comprehend the warehouse lines of credit. Now I comprehend the stop loss funds. Like now I know why the secondary market exists. Before, I didn't have a clear comprehension of why there needed to be a secondary market, but you just shine light on the secondary market is to resell these packages of loans so they can free up those lines of credit to lend again. So they just got paid from those secondary packages that they sold. They still have the line of credit to lend again, charge all. Oh my God.
And then on top of that, they sell those loans at a premium as well. So it's like they're making money hand over fist. So,
and the defaulted ones get sold to debt collector, bro.
And they get to write those loans down as well. So
oh my bro, they gotta come to the Credit Summit.
Make sure y'all at the Credit Summit for sure, 100%. So we're definitely diving
I'm not
deep
one to be lost of words, but literally, bro, like learning how the banking system works and how we can position ourselves through this recession that we're like, because we're in one. A lot of people might be thinking we're not in one. You best believe we're in it. The market has significantly contracted. There's not enough fake money going around anymore. And when I say fake, I'm not talking counterfeit. The only money is coin of silver and coin of gold. That's God's money. But we're really talking about these lines of credits and negotiable instruments that we use every day in commerce for day-to-day transactions. Like, you have to be there. So for those of you that's watching the episode, your greatest investment is yourself, man. You got to invest in yourself. And this type of information, this type of knowledge is not going to be taught in schools. It's not. You want to learn this, the Credit Summit is where you need to be. Hands down. This will be one of your most educational conferences you've ever been at. It's not the fluff stuff where we're getting you hyped up and motivated. Having motivation is good, but we're talking about really giving you an insight and how you can repair, rebuild, restore your own credit, how you can go get funding, how you can tap into different asset class that before weren't available to the ordinary person, but they are available now. And because the information that you didn't know, the things you don't know, And the people that do know the things you don't know, guess what? They will use it against you. So you need to, it's your responsibility to be educated. It's your responsibility to be informed. Stop waiting for somebody to come and save you. The government ain't going to save you. If they were, they would have been saved you a long time ago with the right education. You're not going to get it because the system is designed to sustain itself. The system isn't designed for you to win. In order for you to win, you have to learn the game. And that's something you have to learn on your own, or you get a coach that has been down the road that you want to go, and now you learn it. You go to conferences, you invest in yourself, you submit to a teacher, you learn, you put into practice. That's what I got for them, bro. The Credit Summit is the only place they got to be. That's it.
Let's get it. Let's get it. So yeah. So again, yeah, the Credit Summit. So October 11th through the 13th.
Yep, Atlanta, Georgia.
In Atlanta, Georgia. So this is going to be an event you're not going to want to miss. So definitely appreciate you coming on, Daraine.
Most definitely.
I'll see you down there. And
We're like 3 weeks away, man. Y'all better hurry up and get y'all tickets.
Yes, sir. Yes, sir. All right,
this
then.
Has been amazing, bro.
Let's get it. Let's get it. All right, cool. So